Okay, good morning. Now, so today we'll be starting with a chapter called as non-current assets. But before we start that, we have to study some of the important concepts to run this chapter smoothly. That is called as building blocks. Now, in this chapter of building blocks, what I will do is throughout the entire course, if there are any topics which builds the block or which builds the entire concept surrounding that, okay, so I will be discussing that in the building block part. Okay, so today what I'm discussing here, the basic here is the financial statements. What is the structure of financial statements? What is the structure of financial statements? Will this be asked in the exam? No. Then why I'm discussing it? Because I want you to understand that what exactly is the basic structure of a financial statement. Though I believe that you are already aware of it, but still there might be some students who might not be aware of it. So that's the reason why I am discussing the basic structure of a financial statement, or you can say the components of financial statement is what I'm going to discuss now. Mahima is joining the class. Mahima, nothing was taught yesterday. In the yesterday's class, we just discussed the orientation of SBR. Okay, we just discussed the orientation of SBR. What exactly is the SBR paper now? Okay, so once that recording is uploaded on the LMS portal, you can watch the recording. Okay, so we are starting from today itself. The chapters are getting started from today itself. So, welcome to the SBR batch. Now, structure of financial statements. Now, can you please, all of you, start telling me one by one, what are the components of a financial statements? Tell me, start one by one. What are the components of a financial statements? First component is what? Tell me. So you can write, first one is balance sheet. Second one is, you can say P&L. Third one, tell me what? Cash flow statement. And fourth is notes to accounts. Right? This is what we know, I believe. This is what we know, I believe, right? Now, but there are certain changes to it. There are certain changes to it. Now, what exactly are the changes? Now, we will not be calling it as balance sheet. Okay, we will not be calling it as balance sheet any further. Rather, we'll be calling it as statement of financial position. Okay, or in the short form, I will call it always as SOFP, statement of financial position. Tell me, is it clear? Okay, so it is nothing but balance sheet only, but the name as per the IAS, as per the IFRS, is a statement of financial position. Okay, now P&L. P&L again will not be calling it as P&L. Will not be calling it as P&L. Rather, we will be calling it as statement of total comprehensive income. Okay, statement of total comprehensive income. Definitely, this statement of total comprehensive income will have two components. Okay, statement of total comprehensive income will have two components. And what are those components? The components are P and L and OCI. Now, what is the difference between these P and L and OCI, and what is the meaning of the statement of total comprehensive income? Understand. What happens earlier in if you go as per the local gap, there used to be only P&L. There used to be only P&L. That's what we have studied earlier also. Now, what happens with time when the IFRS was getting structured? So in that, it was the standard setter thought a need of other comprehensive income. Now, what is the meaning of other comprehensive income? So basically, other comprehensive incomes are income or expenses which will not be realized in the near future. Which will not be realized in the near future. Okay, it will be realized, but in the future, okay, there is an uncertainty involved, there is some or the other uncertainty involved, okay. So we will recognize that those type of incomes or expenses in other comprehensive income, okay. To give you an example of it, revaluation reserve, revaluation reserve, right? The gain or loss on revaluation of a non-current asset gets accumulated in other comprehensive income, okay. Now the components which gets recognized in other comprehensive income are of two types, okay. The components which gets recognized in other comprehensive income are of two types. First one is recyclable, and another one is not recyclable. Not recyclable. Now what is the meaning of recyclable and not recyclable? So basically what happens, the components of OCI, other comprehensive income, which are recyclable, meaning thereby on settlement, these other comprehensive income will be reclassified to P&L, will be transferred to P&L, okay. And not recyclable means it will not be transferred to P&L, it will be directly transferred to other components of equity, okay. Now definitely this will create some confusion in your mind, that what exactly is the meaning of or what are the components which goes to other comprehensive income, what are the components which goes to P&L, right? No need to worry about it, okay. Though I am in a position to give you the list, exhaustive list of what are the items which goes to OCI, but I will not be giving that to you now. In the due course of our syllabus, when I will covering the classes, for each and every topic I will be discussing one by one, and I will be telling you that whether it is recyclable or not recyclable, okay. So in the due course of our classes we'll discuss that, okay. Is that clear, everyone? Tell me, is that clear, everyone? Now further, the third part is cash flow statement. I believe all of you are already aware of it, cash flow statement. Now the fourth part, again the one new part that comes up here is statement of changes in equity. Statement of changes in equity. Now what is the meaning of statement of changes in equity? Now understand, guys, in our earlier classes, like when you were in graduation or ACCFR or wherever, so we discussed something called as reserves and surplus, retained earnings, right? Can you recall that? Reserve, surplus, right? Retained earnings, something of that sort, right? So all, like, see, in the equity part we saw equity share capital, we saw retained earnings, we saw other reserves and surplus, right? So statement of changes in equity is nothing but the changes in the retained earnings, reserves and surplus, that's all. So these are the basic components of financial statements. Is that clear, everyone? Neeraj, recyclable part and non-recyclable part, it will get clear eventually when I'm discussing those components, okay. Because if I discuss it also, what is a recyclable part, what is a not recyclable part, and I will not be able to explain you the logic behind that, because the logic for each and every component will be different, right? So what I will do, as and when I will be discussing the components, okay, then I will discuss whether it is recyclable or not recyclable. If it is recyclable, then why it is recyclable, or if it is not recyclable, then why it is not recyclable, okay. I will be discussing that in the each standard as and when it comes up, okay. But I just want you to know so far that there is something like this, I just wanted to know. Recyclable meaning is the OCI can be recycled to P&L. Not recyclable means OCI cannot be recycled to P&L, okay. Let's suppose you had a gain, you earned a gain, okay. Now that gain can be recognized in OCI or P&L. If a gain gets recognized in P&L, it's fine, but if a gain gets recognized in other comprehensive income, then the question here is whether you will transfer that gain which is recognized in OCI to P&L or not, okay. So if you will transfer the gain which you recognize in OCI from OCI to P&L, it is called as recyclable. If you will not transfer from OCI to P&L, then it is called as non-recyclable. Is that clear, everyone? The meaning is clear? Okay, wonderful. Now moving on to my first chapter, that is non-current assets. First chapter, that is non-current assets. Now in the non-current assets, definitely if you look into the book, there are a lot of standards included. If you look into your BPP book or Kaplan book, okay, they have included government grants, they have included fair value measurement. Apart from these standards, they have included others also, but I have not included. When I am saying non-current assets, I mean to say only these four standards. When I am saying non-current assets, I mean to say only these four standards. But if you go into the book, they are including few other standards, like for example government grants, like for example fair value measurement, like for example impairment of assets, right? So they like for example agriculture. Okay, so they have included other standards also, but I have not included it here. Okay, I will be discussing that separately. Is that clear, everyone? Is that clear to all? So please don't get confused that it is given in the book, but I have not discussed it here. I will be discussing it, but I will discuss separately. Okay. Now, so we'll start with the one by one these standards. So my target for today is definitely property, plant, and equipment. And if time permits, I will still try to start investment property now. But before I move on to that, let's discuss what exactly is the meaning of a non-current asset. Can anyone tell me what is the meaning of a non-current asset? What exactly is the meaning of a non-current asset? Anyone? Guys, from the perspective of notes, if you want to make notes along with me, you are free to do that. Okay. Though I will be sharing these notes after the class, after every class, I'll be sharing these notes with you guys. Okay. Now, so I am getting an answer. The asset more than 12 months, which is not a current asset. Okay. Asset held for more than 12 months, expected to realize or get benefit after 12 months. More or less correct. So basically, non-current asset particularly means any asset, okay, with a life more than 12 months, But now tell me, what forget the non-current part now. Tell me, what is the meaning of an asset? What is the meaning of an asset? What is the meaning of the asset? It should be used for the purpose of service or production which provides future benefits. Very good. So basically, when we talk about an asset, when we talk from the perspective of an asset, so asset particularly means that it is an economic resource which will give me future economic benefit, right? Future economic benefit, and which has a life more than 12 months. So can I say non-current asset is an asset? Non-current asset is an asset which will provide me economic benefits for more than 12 months. Which will provide me economic benefits for more than 12 months. Can I say that? Just what I've done is just included these two definitions. Tell me yes or no. Which will provide me economic benefits for more than 12 months. I am not discussing from the point of view of operating a cycle, Aditya, as of now. Okay, we will be discussing the concept of operating cycle, but not now. Okay, so just for now, you can totally ignore the concept of operating cycle. Let's discuss when I am saying current or non-current. Let's focus on the concept of 12 months only for now. Okay. Now tell me, is it clear the meaning of non-current asset? Okay. If at any given point of time you feel that I'm going fast, you have all the rights to tell me that I'm going fast. I will slow down my pace. Okay. Now, so this is the meaning of non-current asset. Now, tell me, the non-current asset are of two types. Can you tell me what are the two types of non-current asset? What are the two types of non-current asset? Come on, guys, tell me what are the two types of non-current asset? Very good, Nisha. So the two types of non-current asset are tangible and intangible. Very good, Nishan. Tangible asset and intangible asset. Now, can you tell me what is the basic difference between a tangible or an intangible non-current asset? The basic difference. See, guys, when I am asking you the questions, I don't want you to answer from the standard. I want you to answer from your logic. I want you to answer from your logic. Physical touch, physical substance, which we can see and touch. Physical appearance, cost factor. Cost factor is not a point, Babita, because tangible and intangible both has a cost. Let's suppose, let me give you an example. This mobile phone is a tangible asset, right? It is a tangible, right? It has a cost included. Now, let's suppose I am using this software. So this is intangible, right? So this also has a cost. This also has a cost, right? So we cannot it is not conclusive that intangible will not have a cost, or it will be difficult to measure the cost of a intangible asset. Okay, it is not a conclusive answer. Okay, now, so what I'm trying to say, the basic difference between tangible and intangible is the physical substance. Tangible asset does have physical substance. They have physical substance. They do have physical substance. They do have physical substance. And intangible does not have any physical substance. So I'll write here no physical substance. No physical substance. That's the basic difference between tangible and intangible assets. Okay. Yeah, guys. So what I'm telling here is, when I ask you any question, I expect you to answer from your logic. Okay, and then what I will do, I will answer what is correct or what is wrong, so that if your answer as per the logic is correct according to the standard also, then you will get a confidence that yes, this is logical. What is happening in the standard, or what is being said in the standard, is logical and not something different, right? So what I want you guys to answer according to your logic, whether it is correct, wrong, doesn't matter, but all of you have to participate. That is primary important, that is important. Okay, now, see, tangible assets can also be further divided into two parts. Okay, tangible assets can be further divided into two parts, and the two parts are called as property plant and equipment, and the another part is called as investment property. Now, so first, let us understand how will you classify. Let's suppose this is a building, or this is studio room. Okay, now this studio room definitely is a tangible asset, but how will you classify whether this studio is a property, plant and equipment, or a investment property? Okay, now this laptop or this entire system which I'm using to take these classes, how will you classify? See, all of these are tangible assets. Right? Now, the question comes up is, how will you classify these assets, whether they are property, plant and equipment, or they are investment property, held for sale or held for own use? Okay, so meaning thereby, if this studio I've held for sale, then it will be investment property. Is it the case? Tell me. Santosh, if it is held for sale, what will it be called as? If it is held for sale, what will it be called as? If a particular asset is held for sale, what it will be called as? Now, investment property, no, my dear friend, you are wrong here. You are wrong here. Okay, let's suppose if a particular asset is held for sale, it becomes my inventory. It becomes my inventory, right? Now, or this laptop I'm using for my own purposes. This laptop which I'm using for my own purposes, but now I want to sell this laptop. But now I want to sell this laptop. I will say 2 points here. Please listen to me very carefully. If I have kept this laptop as held for sale, meaning thereby I will realize the economic benefits very soon, within 12 months. So is it a non-current asset in that case? If this laptop as I have classified as held for sale, meaning thereby I will realize the economic benefits from the sale of the laptop within 12 months only, right? Within 12 months only. So is it a non-current asset in that case? No, it will be current asset. It will be current asset. Current asset by way of either inventory, or there is a separate standard on non-current assets held for sale, and the standard name is IFRS 5. Okay, and the standard name is IFRS 5. So if you can recall, I was telling you yesterday that you have to link the standards. You have to link the standards, right? So the same building can be classified as inventory. The same building can be classified as property, plant, and equipment. The same building can be classified as investment property. The same building can be classified as non-current assets held for sale. Okay, the building remains the same, but it can be classified differently depending upon the purpose, depending upon the use, depending upon the classification. Now, how exactly to do that is our area of discussion now. Is the question clear? Now we have to discuss how we will classify a particular asset as property, plant, and equipment, or investment property. I am not going to the discussion of inventory or non-current assets held for sale as of now. When I will go into those topics, definitely I will help you in explaining that and link also. But so far, as of now, my only agenda is to discuss the difference between the classification of PPE and investment property. Is the question clear now? Okay, guys, my pace is fine. It's not going too fast for you guys. Is the pace fine for you? Okay, fine. Thank you. Now, so first of all, to explain you the difference and the meaning, I want to write the definition of PPE and definition of investment property. Okay, so first of all, individually, I will explain what exactly is a property, plant, and equipment, and what exactly is an investment property. Now, once you have understood the meaning of each of them individually, it is then you will be in a better position to understand the comparative difference between the both of them. Okay, so let us start the discussion now. First point is property, plant, and equipment. But before I go into that, I will write here property, plant, and equipment is covered as part of IAS 16, International Accounting Standard 16. Investment property is covered as part of IAS 40, International Accounting Standard 40, and intangible assets are covered as part of IAS 38, International Accounting Standard 38. Okay, now since they are covered under the respective standards, or there is a different standard for each of them, so it becomes our responsibility to understand the difference in the classification of PPE and investment property. So for that, first of all, we'll discuss the individual meaning of each of them. Okay, so I will write here property, plant, and equipment, PPE. Okay, or let me write it fully. Property, plant, and equipment. Okay, so now the definition says that PPE are tangible assets that we know, that we already know, that PPE are tangible assets held for three things: production or supply of goods or services, or uh, rental, or you can write here administrative purposes, or you can write here rental to others. Okay, and the life of which is greater than 12 months. Now let me write here one more thing. Here it also it is or. Now, so this is the meaning of property, plant and equipment. This is the meaning of property, plant and equipment. So basically it says that property, plant and equipment are tangible assets. We very well know that property, plant and equipment are tangible assets, right? Because see, let's suppose this laptop is a property, plant and equipment, this mobile phone is a property, plant and equipment, this entire setup is a property, plant and equipment. All of them are tangible assets, right? Now further now this property, plant and equipment can be held for any of these three purposes: production or supply of goods or services. This laptop I'm using to deliver the lectures to you guys. So this laptop is a property, plant and equipment. Okay, this laptop is a property, plant and equipment. This studio I'm using to deliver the lectures to you guys. So what happens, since the purpose is to held for supply of services, hence it is called as property, plant and equipment. Now further, administrative purposes, so basically what happens, you would have seen that many all the companies have their corporate office, where the finance team sits, right? Where most of you sits, right? So basically where the finance team is located, right? So basically now tell me, the corporate office where the finance team are located, tell me, is that place helping in the production or supply of goods or services? Is it the case? Tell me. The place where the finance team sits, the marketing team sits, the sales team sits, is that helpful in the supply of goods or production of goods or supply of services? No, no, no. But indirectly, yes, it helps. Not directly, but indirectly, it helps. So that place is also called as administrative, the place which is used for administrative purposes, and it will also be called as property, plant and equipment. Now if you are giving any PPE, any tangible assets on rental to others, that will also be called as property, plant and equipment. Now some student was mentioning in the class right now that if we are giving a asset on rental, it will be called as investment property. But my dear friend, see, rental to others is coming here also. Rental to others is coming as part of PPE, right? So we will be discussing this part. But before I discuss, let me move on to the investment property. Now, what is the meaning of investment property? So investment property, the meaning here is land, building, or both, held for either capital appreciation or rental to others. or rental to others, okay, or both, okay, is called as investment property, okay. Now let us compare these both. Let us compare the definition of both of them, property, plant and equipment, and investment property. Let us compare the different the definitions and understand the difference. Okay, Mahima is asking, is there any difference between IAS and IFRS? Mahima, I believe this is your first class, right? So if you watch the previous orientation lecture, I have discussed this thing. Okay, but just to answer your query, I will tell you that IAS are the part of IFRS. Okay, IAS are a part of IFRS. Now, so in property, plant and equipment, and in investment property, first understand what is the meaning of each of them. Understand, property, plant and equipment, they are tangible assets. Investment property, they are also tangible assets. Okay. Now, property, plant and equipment can be held for use for any of these three purposes: production or supply of goods or services, administrative purposes, or rental to others, meaning thereby if there is a tangible asset held for any of these three purposes, it will be called as property, plant and equipment. Now if there is a land or building or both held for capital appreciation, or for rental to others, okay, or both, then it will be classified as investment property. Now the question that comes up, or the query that arises here is, you should ask me that this part says rental to others, and even this part also says rental to others. Then what exactly is the difference? Here? Tell me. Can anyone answer this part? Can anyone? Just give it a try. Whether you are right or wrong doesn't matter, but give it a try. What exactly the difference between these two rental? Asset other than land and building is covered in PPE. Okay. So Mahima, can I say this studio, which is a building, will always be investment property? Tell me. Can I say that this studio, which is a building, will always be investment property? If that's the case, then the classification is quite easy. All the land, building, or both investment property, rest all property, plant and equipment, right? And if that is the case, then why this term uses property here? Directly should write plant and equipment only. No, that is not the case. So the standard is trying to say very logical point. Let's suppose Aditya has rupees 50 lakh cash in hand. Okay, Aditya has rupees 50 lakhs cash in hand. Aditya, tell me, will you in that 50 lakhs, I am giving you two options. Okay, purchase a very high-tech laptop, or purchase a land. You have to do the investment. So where will you invest? A very high-tech laptop or a land? Tell me. Why land? Why not high-tech laptop? Why land? Why not high-tech laptop? Because the laptop are depreciating assets. Right? They will depreciate in the value. Okay. Now, but the land or a building, they appreciate in the value, right? So whenever we discuss from an investment perspective, we will always do the investment in the land or a building. We will not invest in any asset. Okay, any asset when we call it in a laptop or any monitor or any mobile phone. No, we will not invest in these, right? All these are, you can say, expenses sort of thing. Not exactly expenses, but capital expenses, you can say. Okay. Now, not appreciating assets, you can say. Building is depreciating asset. Mayur, I totally agree with you. Though we depreciate the building due to wear and tear of the building, but the value of the building always increases, right? The market value of the building increases, though we depreciate the value for wear and tear of the building. Tell me yes or no, Mayur? right? So that's what. Now, so what is the difference? Now again, the question remains unanswered. The question remains unanswered. What is the difference? So let me write here the difference. If there is any tangible asset, if there is any tangible asset held for production or supply, tangible asset, and it is non-current, okay, non-current tangible asset, production or supply of goods or services, okay, it will always be called as property, plant and equipment. If there is a tangible non-current asset which will be held for administrative purposes, it will be called as, always it will be called as PPE. Okay, let me give an example. Okay, machineries in a factory, they are PPE. The factory building, the land where the factory building is located, okay, all those are property, plant and equipment. Okay, so it can be the case that a land is a property, plant, equipment. A factory building is a property, plant, building. Office building is a property, plant and equipment. Okay, office equipments, furnitures and fixtures are property, plant and equipment. Third, if it is held for rental to others, if it is held for rental to others, or not rental to others, I will write here, if it is held for capital appreciation, if it is held for capital appreciation, then it is held for, you can say, it is investment property. It is investment property. And capital appreciation, when I say, means what? Land, building, or both. I mean to say only this one. Land, building, or both held for capital appreciation is called as investment property. And now comes the main target point. If it is held for rental to others, if it is held for rental to others, then we have to do this particular point. Assessment here. The rental, if I am giving an asset on rental, I have to see what exactly is the asset. If the asset is land and building, or both, land, building, or both, if the asset which I am giving on rental is either land or building or both, then it is classified as investment property. And if it is any other asset, if it is any other asset, then it will be called as property, plant and equipment. This helps you in the understanding of the classification of the property, plant and equipment and the investment property. Tell me guys, is it clear everyone now? Tell me guys, is it clear everyone now? So now if I have to make a change here, I say rent, when I'm saying rental to others, I can say here except rental of land, building or both. Why? Because the rental of land, building or both are covered under investment property. Okay, when I say rental to others, I am saying only for the land, building or both. Is that clear everyone? So meaning thereby this studio, since I am using this studio for delivering my lectures, so meaning thereby this studio will be classified as, tell me, what will be the classification of this studio? PP. Very good. Okay, now just beside the studio, I have purchased a land and kept it off. Now tell me, what will be the classification of that land? Investment property. Okay, now what if the company's purchased gold will be classified under PPE? Yes, though the standard doesn't mention it explicitly, but yes, it will be classified under PPE. Okay, definitely not under investment property, because investment property is a standard which covers specifically land, building and both. Okay, and nothing else. Is that clear everyone? Okay, now definitely we will discuss the meaning of investment property in much detail when I will discuss the chapter of investment property. But my agenda for now is not to discuss investment property. My agenda was to just to help you in understanding the classification difference between PPE and investment property. Tell me, is that clear for everyone now? Is the classification clear to everyone? Okay, now, intangible assets, there is no challenge. Intangibles, there is no such classification difference. Now, difference is from tangible and intangible. The basic difference is physical substance, and I believe that is clear to everyone now. Now, with this, on this note, I am moving on to my first standard for today, that is property, plant, and equipment. Now, I received one query. What is the benefit of that classification in accounting treatment? Now, first benefit. Let me tell you the benefits. Benefits are two ways, academically and practically. So in the exam, a question might come up that the entity has purchased a building. The building was given on rental, but the company has applied IAS 16 on that building. So that is wrong. That is wrong, right? So you need to understand the accounting treatment. You need to understand the classification to suggest the correct accounting treatment. You need to understand the classification to suggest the correct accounting treatment. First point. Second, if you go if you qualify, once you qualify ACCA and you work in a practical world, there also it will create a high value for you if you know what exactly is the difference between PPE and investment property, because these are very small points which generally the people are not aware of, the accountants are not aware of. So if you are aware of it, then definitely you will create an edge over others, right? You will create an edge over others. So as I was mentioning in the first class also, and I will repeat the same point here, please always try to understand the logic why. Please always try to understand the logic why behind each and everything. It will help you academically and practically both ways. Now, moving on to my first discussion of the standard, that is IAS 16. Property, plant, and equipment. Now, question comes up, do we need to remember or recall the standard name and the number in the exam? Tell me, a question comes up, do we need to remember the standard name and the number in the exam? The examiner is clearly trying to say that even if you write the name and the number of the standard, I will not be giving you any extra credit for that. I will not give you even a single mark for that, okay? So is that logical to remember it? From a marks perspective, no. From a marks perspective, no. From an impression perspective, no. No, it will not get any impression. No added impression. So do we need to write that in the exam? See, if you are very much sure that you are correct, write it off. If you are not sure, then don't write it off. If you write, there will be no extra credit. But if you write it wrong, there can be deduction of marks. So please don't write, okay? But I will say you should remember the standard name and number, because you are not studying only for the exams. You are studying for your career, right? And practically, if you remember the standard name and number, it is quite good, right? So you should remember the standard name and number, not from an exam perspective, but from a practical perspective. Is that clear? Now, so whenever we discuss I will discuss start the discussion of any standard, I will discuss few things always. What? First, the meaning of it. I will always discuss the meaning of it. Second, I will discuss the recognition principle. I will discuss the recognition principle. Then I will discuss the measurement principle. and then I will discuss the disclosure requirements. Now, let us understand, first of all, what exactly is the meaning of these 4 points. What exactly is the meaning of these 4 points? Okay, then definitely I will start the discussion into it. But first of all, understand what exactly is the meaning of a recognition principle, measurement principle, and everything. See, I believe I don't need to explain the meaning of meaning, right? So in the meaning part, I will discuss with you what exactly is the meaning of property, plant, and equipment. Okay. Now, in the recognition principle, I will discuss, let's suppose if you have a property, plant, and equipment, meaning thereby asset qualifies to be a property, plant, and equipment. The question comes up whether I should recognize this property, plant, and equipment in my financial statements or not. Okay. See, now understand. Let's suppose I have purchased a laptop. I have purchased a laptop. Okay, so the definitely laptop, the life is more than 12 months. Life is more than 12 months. Okay. Now the laptop is used for, you can say, admin. For me, the laptop I use for supply of services. I use the laptop for supply of services, that is delivering the lectures to you guys. Supply of services. Okay. Now, so hence I can say it is a property, plant, and equipment. Tell me yes or no. The laptop is a property, plant, and equipment for me. So this is called as the meaning thereby that whether a particular asset qualifies to be a PPE or not. Second point I will discuss. This first point is called as the meaning. This is called as the meaning. Second point, it is recognition principle, means recognition principle means if this laptop qualifies to be a property, plant, and equipment, then whether question comes up is whether the entity should recognize this laptop in financial statements or not. Then you should ask me a question here that, sir, if this laptop qualifies to be a property, plant, and equipment, then why this question is coming up whether I should recognize this laptop in the financial statements or not? Definitely I should recognize. No, that is not the case. That is not the case. That is not the case. Why? Because what happens, the basic meaning of an asset is that it will give me future economic benefits, Now let's suppose I have purchased a laptop. Okay, I have purchased a laptop, but I conclude that after purchasing the laptop, I conclude that this laptop is of no use for me, and it will not give me any future economic benefits. It will not give me any future economic benefits, right? So hence I will not be able to recognize that in my books of account. I will not be able to recognize this laptop in my financial statements, even if it qualifies to be a property, plant, and equipment. Are you understanding the meaning of recognition principle? Tell me, guys. Okay, now the third point is measurement principle. The third point is measurement principle. Now in measurement principle, we discuss here that, see, so far we discussed whether this asset qualifies to be a PPE or not. Okay, I'll write here. So far we discussed whether this laptop qualifies to be a PPE or not. First point. Second point is, if it is a PPE, if it is a property, plant, and equipment, then whether to recognize in FS or not. This is what we studied so far. Now, third point will be in the measurement principle. The third point will be, if at all entity has to recognize laptop as PPE in financial statements, then the question comes up, at what amount? And this is called as measurement principle. Okay, this is called as measurement principle. Now the fourth point that comes up is disclosure requirements. So in disclosure, we try to maintain transparency. Whatever are the important information about the property, plant and equipment, we disclose each and everything. Like for example, what is the residual value for this laptop? What is the life of this laptop? Okay, all those things we will disclose as part of the disclosure requirements. Now tell me guys, is it clear the meaning of these 4 points? Definitely we will be discussing in much detail about these 4 points, but tell me, is it clear what exactly is the meaning of recognition principle? What exactly is the meaning of measurement principle and disclosure requirements? Is it clear, everyone? Wonderful, wonderful. So now coming to each of them one by one. First point is meaning of property, plant and equipment. I believe I have already discussed the meaning of property, plant and equipment, and that is clear to all of you. Tell me, I believe I have already discussed the meaning of property, plant and equipment. Right? Now, moving on to the second point. That is recognition principle. Now, let me tell you one thing, guys. SBR paper is a lengthy paper. Okay, Pratiksha, I will take up that query, but just please understand, I think this query will automatically get answered by the end of this lecture. Okay. Now, SBR paper is a very vast paper. Okay, not definitely as vast as if you are from a CA background, not definitely as vast as that, but it is vast. Okay. But understand, so how to tackle this paper? Okay, guys, understand that I believe most of you are working professionals. Okay, so definitely you will take around a week or 2-3 days or 4-5 days of leave before your examinations. So definitely it will not be practically possible for any of you to revise the entire SBR in that 4 or 5 days, right? So what I will recommend you from the very beginning, from now itself, that after completion of each and every standard, please start to make your own concept notes. Okay, wherein you are writing each and everything in a summarized manner, in a very crisp manner. Okay, so that it will help you in the revision at the end. Okay, it will help you in the revision at the end. Okay, now once you have made the concept notes for any given standard, make sure that whenever you are revising it again, whenever you are revising that standard again, you are revising from that concept notes only. If at all you find that there are certain changes to be done in the concept notes, make those changes, but revise from that concept notes only going forward. Okay, so you need to ensure this, that you are doing this. If you do this, the things will become quite easier for you. Okay, practice will be my responsibility, but you have to make the concept notes, revise it time and again. As and when I am saying you have to revise it everything, but yes, you have to make your own concept notes. You have to make your own concept notes. Even I have made my concept notes, okay, but that I will be sharing by way of revision classes at the end, okay, not now, because I want you guys to make your own concept notes. Is that clear to everyone? Will you do that? Tell me, will you do that? Might be it will initially it will take you some time extra, but it will be of great help, trust me. Now, coming to the recognition principle. So it says that any asset that qualifies to be a property, plant, and equipment can be, if you want, you can write the notes along with me here, can be recognized in financial statements if and only if it satisfies both the below mentioned conditions. And the conditions are, it is probable, I will take this color pen, yeah. It is probable that future economic benefits will flow to the entity and cost can be measured reliably. Don't forget the word and here. Don't forget the word and here, okay? It is quite very important. And you can write it off and then we'll start discussing it one by one. Let me know once done writing. So, done. Very good. So it says that if any asset or if any amount that you have spent qualifies to be a property, plant, and equipment, okay, then we have to assess whether that can be recognized in the financial statements or not, okay. Then we have to see that that will be recognized in the financial statements or not. Now further to assess whether it can be recognized or not, we have to see two conditions, and the two conditions are, it is probable that the future economic benefits will flow to the entity. Now, as I was taking up an example of a laptop, so basically, I have purchased a laptop for my classes purposes. But after purchasing the laptop, I thought and I realized that with this laptop, I will not be able to take the classes. I will not be able to take the classes. And this laptop is of such a specific, you can say, the components are such specific that no one else can use this, okay, except for me. No one else can use it off. So if I, even if I try to sell that in any platform like OLX or any other platform, if I try to sell it off, it will not get sold, because no one will require such a high such a designed laptop. Okay, no one will require that. So neither I am able to sell the laptop, nor I am able to use a laptop. Okay, so it means that though I have purchased a laptop and the laptop qualifies to be a property, plant and equipment, but since I do not have any economic benefits from this laptop, meaning thereby this laptop, though it qualifies to be PPE, but it does not have economic benefits. If it does not have economic benefits, it beats or it defeats the basic meaning of an asset. It defeats the basic meaning of being an asset, because the basic meaning of being an asset is means that it will have future economic benefits. And if this laptop does not have future economic benefits, meaning thereby it is not an asset. It is not an asset itself, right? So can I recognize this amount as a asset in my books of account? No, I cannot do that. Then what will be the treatment of that? The amount which we have spent will be written off in the books of account, right? Very good, Aditya. It will be written off in the books of account. Yes. Okay. Now, the laptop which I have purchased, the laptop which I have got. Okay. Now, this laptop definitely it will have economic benefits. The laptop definitely it will have economic benefits, but I am unable to measure the cost of it. Okay. Now, let me tell you. While I was, what happened? This laptop was gifted to me by my brother. Okay. My brother gifted me this laptop on my birthday. Now tell me, definitely this laptop is having will give me future economic benefits. Definitely this laptop will give me future economic benefits. But do we know the cost of it? Tell me. Have I incurred any cost for it? Did I incur any cost for it? Tell me. Did I incur any cost? No. Right? No. So it again beats the basic qualification for an asset. Okay, because it is not a monetary transaction. So hence it will not be recognized in the books of account. Okay, though when the asset is gifted to us, or the asset is given by the government to us by way of grant, then we can recognize the asset at its nominal value. Okay, nominal value. So it in a sense we are not recognizing the asset. Okay. 113 is nothing that you are talking about Ind AS, Aditya. Let's talk from a perspective of IFRS. So from IFRS, it is IFRS 13, fair value measurement. But that comes into the picture if and only if the asset is under a revaluation model. Okay, that comes into the picture if and only if the asset is under revaluation model. But now what we are discussing is, initially shall I recognize the asset or not? Okay, Siddharth, you are saying so far gifted assets will not recognize PP. Understand, if we go theoretically, yes, we will not recognize it off. Okay, if we go theoretically, we will not recognize it off. But what happens? Let's discuss it practically. If the entity is using any laptop, okay, now, but the laptop was gifted to the entity. So the IAS 16 says that you are not required to recognize the laptop. Okay, so theoretically we will not be recognizing the laptop, and that is correct. But let's suppose at year end, when the auditor comes and asks, they do the physical verification of the asset, what they will notice, there is an asset on ground, but that is not recorded in the books of account, right? That is not recorded in the books of account. Tell me yes or no. So that will create a difference. So just to mitigate the difference, what is general industry practice, they record the asset but at very nominal value, that is $1. Okay, or in Indian terms we can say ₹1. Okay, is that clear? What if purchase was for consideration other than kind? Okay, Purchase was for consist other than cash. I think you should write other than cash, not kind. Yes, yeah. So that I will discuss again today in the topic of exchange of assets. I will discuss a topic called as exchange of assets. Okay. So there I will be discussing that part. Okay. That is a separate discussion altogether. So I will discuss that part. Exchange of assets, or we call it as a barter transaction. Barter transaction. Okay, Mahima. Now, so this is what is called as the recognition principle. Now, so understand for a PPE, basic crux. I am writing the basic crux. For a PPE to be recognized, in financial statements, okay, it should be, first of all, it should be a PPE. It must be a PPE plus it should satisfy a recognition principle. It should satisfy a recognition principle. It is then only it can be recognized in the books of account or in the financial statements. It is then only it can be recognized in financial statements. It is then only it can be recognized in financial statements. Is that clear, everyone? Is that clear, everyone? If either of these, if any of these does not meet, let's suppose the recognition principle is satisfied, but it does not satisfy to be a PPE. Can I recognize the financial statements as PPE? Can I recognize in financial statements as PPE? No, I cannot do that. Okay, it satisfies the meaning of being a PPE, but it does not satisfy the recognition principle. Can I recognize that? No, again we cannot recognize. So for recognizing any amount spent as PPE in the financial statements, it should satisfy both of these. That is the meaning also and the recognition principle as well. Is that clear, everyone? Is that clear, everyone? Let us take up examples now. Let us take up examples. Tell me what is the conclusion. Tell me what is the conclusion. Those who said investment property, claps for them. How come? I said na, investment property can only be land and building or both. Is this laptop a land or a building? Is this laptop a land or a building? No, it will be classified as PPE. That's what I wanted to test. Second point. Now tell me, FEB means future economic benefits. FEB means future economic benefits. Is it clear, Palak? Now, so it is PPE. Now, third point, a flat. Okay. 2 BHK flat. The life is 30 years. Is for investment. Now tell me. Very good. Investment property. After land, I will take up a laptop. A machine. Now tell me. It is a PPE, but it will not be recognized. It will not be recognized. It will not be recognized. Okay. So what we'll do? Expense of in P&L. Expense of in P&L. Expense of in P&L. Last example. A machine. Now tell me. Yes, Goel is saying PPE. Vijaya is also saying PPE. It's not a non-current asset. PPE is a tangible non-current asset. The life, what was the definition of PPE? You forgot the definition. What is the definition of PPE? The life is more than 12 months. The life is more than 12 months. Is the life more than 12 months? See, is the life more than 12 months? No. Right? So you what will do? You will expense of in P&L. Expense of. Okay. Expense of. Or you can say not a non-current. I will write here. Rather than writing expense of, because we might not expense of also. Right here, not a PPE. Not a PPE. Not a PPE. Simple. Is that clear, everyone? Okay, let me write one more. Let me write one more example. It's building. Now tell me. PPE. Very good. Okay, one more. Now tell me. Investment property. Now I believe you guys good to go. Tell me. Is it clear, everyone, now? Is it clear, everyone, now? Is the understanding clear now? The meaning of PPE, IP, the recognition principle, is everything clear so far, everyone? Very good. Now, moving on to the, tell me what is the next topic that I will be taking up now? Tell me what is the next topic that I'll be taking up now? Measurement. Very good. Measurement principle. Measurement principle. Now, the measurement principle is divided into two stage. Is divided into two stage. One is called as initial measurement. And another is called as subsequent measurement. Do you know the difference between initial measurement and subsequent measurement? Tell me, guys. Do you know the difference between initial measurement and subsequent measurement? Now, let's suppose this is the life cycle of an asset. Okay. Now, this is the date of purchase, and this is the end of useful life. This is the end of useful life of the asset. This is the end of the useful life of the asset. Now, so the accounting treatment that we do on the date of purchase is called as initial measurement. Okay. The accounting treatment that we do over the entire remaining useful life of the asset is called as subsequent measurement. Is that clear, everyone? Is that clear, everyone? Now, further, if the entity incurs any expense, if the entity incurs any expense over the entire remaining useful life of the asset, that will be which we call as subsequent costs. Subsequent costs that will also get covered under initial measurement. Is that clear, everyone? I have told 3 points. I have told 3 points. Tell me, is it clear, everyone? So how will I classify? So initial cost will again be divided into two parts. Is called as initial costs, that is on date of purchase, and subsequent costs, that is over useful life. Is that clear, everyone? Is that clear, everyone? Now, subsequent measurement, we have an option to measure the asset at cost model or revaluation model that we'll discuss further. Okay, but now, so this is what is the measurement principle. Let me know if that is clear to all of you. Definitely we'll discuss everything, each and everything in detail, but tell me, a mind map is clear to all of you? A mind map is clear to all of you? Yes, definitely, Palak. But I'm not saying now that I should capitalize it or not. I'm not saying now. As of now, I'm just saying what will be covered under initial measurement and what will be covered under subsequent measurement. Okay. I haven't discussed so far that it will be capitalized or not. Okay. That I have to discuss. Okay. But tell me, is it clear, everyone? The mind map is clear, everyone? Okay. Let us start the discussion of initial measurement. Point number 4. Guys, you are done writing this part? You're done writing this part? Okay, wonderful. Point number 4 is initial measurement. We'll discuss first what initial costs or initial measurement, right here. Initial measurement. Now, under initial measurement, what we can write here is, tell me, when you purchase the asset, whenever, think, guys, always think practically that you are in that position, then you will do. Okay, now let's suppose you are purchasing an asset. Tell me, at what price will you recognize that asset in your books of account? At what value will you recognize the asset in your books of account? Tell me, at what value do you think you will recognize the asset in your books of account? Purchase cost. Okay, so rather than saying purchase cost, can I directly say at its cost? Can I say at its cost? Can I say at its cost? Can I set its cost? Now, the cost can have multiple components. The cost can have multiple components. Okay. Now, what are the multiple components? Now, the standard says that cost includes what? The components of cost. So, first component of cost is purchase price. The first component of cost is purchase price of the asset, adjusted for any trade discounts or rebates or cash discount. But cash discount, you have to strike it off. Why exactly? I will discuss that. First, let me write the meaning, and I believe, and I will ask all of you, you first write the meaning of cost, and then I will discuss each and everything in detail. Okay, now, purchase price plus any non-refundable taxes. Okay, plus any other directly attributable costs incurred to bring the asset to the location and condition intended by management. Okay, plus or minus any finance costs. Okay, or I will write here directly any finance costs under IAS 23 minus any finance costs under deferred credit terms plus provision for dismantling or decommissioning or removal costs. Okay, the amount that comes up net is the amount. This is the amount. This is the cost. The amount that comes is cost at which PPE will be capitalized initially. First of all, please write it off and let me know once done, and then I will start discussing it one by one. Non-refundable taxes or duties. Do let me know once you're done writing this part. Santosh, done. Yes, done. Chalo, done. Now, what happens? Whenever you purchase the asset, definitely you have to pay the purchase price for that. You have to pay the purchase price of that. Okay. Now, when you purchase, the vendor might give you some rebates or trade discounts or cash discounts. Okay. Now tell me, what is the reason for trade discount and what is the reason for cash discount? Can you tell me the reason for giving the trade discount, or what is the reason for giving the cash discount? Can you give me the reason? What exactly is the reason for that? Payment terms. Payment terms is for what? Trade discount is to pass on the benefit, not specifically. Trade discount is given to reduce the price, or you can say to promote the sales. Trade discount is given to promote the sales. Okay. Cash discount is given to promote the early payment, Okay. Very good, Nishan. Very good, Hunar. Very good, Honor, and yes, Goel. Okay, very good, very good. Now, so basically what happens, the trade discount is given for the bulk purchase or to promote the sales. Now what happens, this discount of trade discount is directly linked to the purchase. Since I have purchased, I have got the trade discount. But now cash discount, is it given for the sale, or is it given that since I have purchased, is it given? No. It is in the nature of financing benefit. It is in the nature of finance. Very good, Siddharth. Very good, Siddharth. Okay. So now, since it is in the nature of finance, we will not be considering it here. Rather, we will consider that here separately. Okay. So that's the reason I'm saying cash discount is not covered. Okay. Even if there is a cash discount, do not adjust the cash discount. Do not adjust the cash discount as part of the purchase price. Is that clear, everyone? Only if there is a trade discount, I will be discussing it. Otherwise, if there is a cash discount, ignore it off. Okay. Now, what will we do? If there is a cash discount, I upfrontly transfer it to P&L. Okay. If I have given discount, I will transfer to P&L as an expense. If I have got the cash discount, then I will transfer it to P&L as income. Okay, other income. So that will be the treatment of cash discount. So cash discount will not be adjusted with the purchase price. Is that clear, everyone? Now, coming to non-refundable taxes. Okay, now understand. Now, are you aware of it that if you purchase any asset for business purposes in India, then you will get the GST credit for that? Are you aware of this point? Right. So now let's suppose I purchase this laptop. For INR, let's suppose 2 lakhs. Okay. Now when I purchase this laptop for INR 2 lakhs, I also paid a GST, that is goods and service tax, in India for, let's suppose, around 30,000. Okay. Now tell me what, and I took the credit of that. I took the credit of that. Okay. Now tell me what is the net cost for me? 2 lakh or 1,70,000? What is the net cost for me? 2 lakh or 1,70,000? Tell me. What is the net cost for that? 1.7 lakhs. Okay. Now similarly, my brother also purchased a laptop for his own personal purposes. Okay, for his own personal purposes, he purchased a laptop. Now, what happens when he purchased a laptop for his own personal purposes? Now, in that case, the same laptop he purchased, then for him the cost is 2 lakhs, not 1.7 lakhs. For him, the cost is 2 lakhs, not 1.7 lakhs. So that's why it says we have to add the non-refundable taxes. Since the taxes which I paid was refundable back to me, hence I didn't consider that tax. Okay, but when my brother purchased a laptop, the taxes which he paid was not refundable back to him, and hence he has to add back the add the amount of taxes which he paid. Is it clear, everyone? Is it clear, everyone? The meaning? Tell me. Purchase price and non-refundable taxes. Is it clear, everyone? Now, any other directly attributable cost incurred to bring the asset in the location and condition intended by the management. This is a very, very, very important point. And this is an area where I have seen students making mistake. Okay, but you are not required to do that mistake. Okay, you have to be very much diligent here. Now, let me discuss this part. The other directly attributable costs. Other directly attributable costs. So understand, guys, when I say other directly attributable costs, you have to understand the meaning of it. So basically, standard says that when I purchase an asset, it is not the case that when I purchase the asset, I can start using it then and there. No, 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 no. So when I purchase the entire studio setup, okay, I purchased one equipments, okay, from one store only, but I purchased one equipments. Okay. Now tell me, when I purchase the equipments there from the store, can I start using it there itself? Tell me, can I start using it there itself? No, right? So I have to bring it to my studio first. I have to bring it to my studio first, right? Now, once all the equipments are brought in the studio, can I start using it then here itself? No. First, then I have to get it installed. Everything has to be installed, right? Now, once everything gets installed, it is in that case, after that I can use the asset. So what happens? Whatever costs are being incurred to make the asset in a usable condition that is available for use, to make the asset in a condition that is available for use, we will after that only till that time I will capitalize all the expenses which are being incurred right now. So to bring the all equipments from the seller's premises to my studio, I will capitalize the transport costs. Now, once it reaches to my location, I have to bring it to the condition in a manner how I have to use that equipment, right? So that equipment has to be installed. That equipment has to be installed, right? So I have to pay the installation fees also. So that will also be capitalized to the studio. That will also be capitalized to the studio, right? So any cost incurred to bring the asset in the location where I have to use and in the condition of how I have to use. When I say a location, I mean to say where. Okay. When I say condition, I mean to say how. Is it clear, everyone? So any condition, any expenses incurred till the time the asset is asset becomes available for use will be capitalized. All the expenses till then will be capitalized. But yes, once the asset is capitalized, okay, any expenses incurred after that will be called as subsequent costs. Once the asset becomes available for use, any expenses incurred after that date is called as subsequent costs. And I'm not discussing subsequent cost as of now. I'm just discussing initial cost. Is that clear, everyone? Now tell me, is that clear, everyone? Now, but there are certain specific points which I have to discuss. Okay, so I will write here the example first. Example for this is called, can be called as transport costs. The example for this can be called as installation costs. Now, when I say condition, let me tell you one thing. Let's suppose there are two friends. Okay, let me take up the name of two students. There are two friends, Rohit, and who else? Who else I should take? Siddharth. Now, so what happens? They are two friends. Okay. Now Rohit and Siddharth, both of them wants to purchase a car. Both of them wants to purchase a car, but their use is different. Rohit just wants to drive the car to his office. That's all. Okay, for his like normal use. But Siddharth wants to use the car for racing. Okay, he's a racer, and he wants to use the car for racing purposes. Okay, now. So Rohit and Siddharth both went to a car showroom and purchased a same car. Both of them purchased the same car. Okay, and incurred an amount of, let's suppose, rupees 8 lakhs. Both of them purchased the same car and incurred an amount of 8 lakhs. Now Rohit says that see, my purpose is to use the car for normal purposes. So this car is in my intended condition. And hence I can capitalize the car at 8 lakhs rupees. Okay. But Siddharth says that no. This car is not in the intended condition. Though the car is available for use, but the car is not available for use in the condition in which Siddharth wants to use it, right? So Siddharth will take that car to I don't know what to say, a mechanic or someone else who can modify the car for him, and make it a sports car. Okay, now so that and that will take, you can say, 2 months extra time. Okay, and it will cost him 4 lakh extra. So Siddharth will not capitalize, Siddharth will wait for 2 extra months and capitalize 4 lakhs extra, and then capitalize the car at 12 lakh. Okay, so this is what I'm trying to say. When I say intended condition, meaning thereby the asset is same. I can capitalize it now, but the Siddharth can capitalize it after 2 months. Why? Because the intended condition can be different for different persons. Right? So according to the intended condition, that's why I have written here location and condition intended by the management. Okay, so whatever is a condition intended by the management, any cost incurred till that date shall be capitalized. Is it clear, everyone? Very good. Now next point, few specific points. Point number 1, employee costs. Point number 2, advertisement costs. Point number 3, you can say employee cost done, advertisement costs done, then comes testing costs. testing costs. So I've discussed these 3 points specifically with you guys. Now, employee costs can be of two types. Employee costs can be of two types. And what are two types of employee costs? The type one of employee costs is salary to construct the asset. Okay. Type 2 is training to employees on use of asset. Now the treatment is different for different these costs. The treatment is different. Okay. Now you have to understand the meaning of each of them. Understand. You are paying salary to your employees for constructing the particular asset. You are paying salary to your employees for constructing the particular asset. Now, what happens? Tell me, how do we pay salary? Tell me. First of all, the employee works on construction of the asset of that particular asset. Then at the month end, we pay the salary to the employees. Tell me yes or no. Tell me, right? Now the salary cost which we are paying to the employees is for the construction of a PPE. Assuming that that construction satisfies the definition of PPE, assuming that it satisfies the definition of being a PPE, now answer me two things. Can you measure this cost? Can you measure the cost? Right. Is it probable that the future economic benefit from these costs will flow to the entity only? Siddharth, I didn't ask will it be capitalized or not. I am asking only will the cost be can the cost be measured? Yes. Will the economic benefits from the salary that I have paid to the employees flow to the entity only? Yes. Why? Because the salary which I am paying to the employees is for the construction of the asset, and since the asset is already getting constructed, whatever is the benefit from the construction of the asset will come to me only. Will come to me only. Tell me yes or no. Right? So what I will do, I will say that this will be capitalized to the cost of asset. This will be capitalized to cost of asset. Yes, Rohit, please tell me. Okay. Rohit, understand. You can acquire the asset using two methods. One, you can directly go and purchase the asset, okay, or you don't want to purchase, rather you want to construct the asset in-house. You want to construct the asset in-house. So don't you think if you are constructing the asset in-house, and whatever is the salary which you are paying to your employees or wages that you are paying to the laborers will be capitalized? Don't you think so? That is the construction costs. Don't you want to capitalize the construction cost? Tell me, Rohit. To save the installation cost, I can use my technical employees. To save the installation cost, I can use my technical employees. I didn't get your point. I think you're not getting the question itself. My question is, you have two options. One, directly purchase the asset. One, directly purchase the asset. In that case, definitely, if you are purchasing the asset, you will not incur the employee cost to construct the asset, because this is for constructing the asset, right? Now, if you are going for option number two, that is rather than purchasing the asset, if you go and construct the asset, so for constructing the asset, definitely you have to deploy the employees. You have to deploy the employees on the construction. Right now, the employees who will construct the asset, the salary which I pay them is directly attributable cost, right? Indirect employee overhead cost for the direct employees can also be capitalized. Okay. Now understand. You are going into the details of it. Let me answer that as well. The employee cost can be again two types. one is the direct employees who are working specifically on that construction itself. Okay, definitely I will capitalize the cost for that. Now another set of employees who are not directly working on that project, but who are working part time on that project. Okay, now for that also I have to allocate that what portion of the salary cost is pertaining to this project. Okay, that is called as directly attributable overhead cost. Okay, what I'll do is I'll discuss it off here. As part of point number 2. I will discuss it off. Overhead costs. Don't worry. I will discuss overhead costs also here. Okay, but this is what I'm trying to say. Is it clear now, Rohit and Siddharth? Now, training to employees on use of the asset. Now, let's suppose you are working in a you are working in your CA firm. Okay, you are working in a CA firm. Now, when you're working in a CA firm, so what happens? The principal of the firm, the partner, the lead partner of the firm wants to give you a training on GST and income taxes. Wants to give you a training on GST and income taxes because he has purchased a specific software. Which will help in easy filing of GST returns and income tax returns. Okay. Now he wants that his employees should get trained in that. And he incurs training costs. Now question is, can that training cost be capitalized to the cost of that asset? Can this training cost be capitalized to the cost of the asset? Okay, everyone is saying no. Can you tell me why? Why will we not capitalize? Tell me why. As we are not receiving benefit. How? Because if the employee learns, if the employee is trained, I will definitely get the benefit. I will definitely get the benefit. How can you say that there is no increase in the benefit? There is an increase in benefit. There is an increase in benefit, because if my employees are trained, they will be able to work effectively, right? So definitely I'll get the benefit. Employees may leave after the training. Very good, Mahima. Very good, Ramesh. Okay, employees are not controllable. See, I gave the training to my employees today. Tomorrow they might resign. Right? Do I control this cost? Do I have control over this cost? No, I don't have any control, right? I don't have any control. Though there are economic benefits, but it is not probable that it will flow to the entity only. Okay, there are future economic benefits, but it is not probable that they will flow to the entity only. See, in the recognition principle, I didn't write that there are future economic benefits. Rather, I wrote it is probable that the future economic benefits will flow to the entity. In the case of training cost, it is future economic benefits are there, but it is not probable that they will flow to the entity. Okay, it might flow to some other entity, because the employees may learn from us and might leave the job and start his own practice, or might join somewhere else. So it might flow to some other entity. Which we cannot control, right? And hence we cannot capitalize the training cost to the employees. Is that clear, everyone? As I mentioned, that the knowing the reason why is quite very important. Let's say a contract is entered not to leave for 3 years, then okay, see, that can be for one employee, two employees, right? Not for all the employees. Is it the case that for all the employees I can do that? And still, even if there is a contract, as per the law, there is nothing which can bound an employee to remain in the company for 3 years, right? They can resign, right? Even if there is a contract, there is nothing, no law which can bound them to the company. Okay, and still if it is there, that yes, they can be bound, then yes, in that case you can capitalize. Only condition is if it meets the recognition principle, yes, we can do that. Okay, there can be n number of hypothetical situations, but yes, we have to understand what exactly can be the general practical situation. Clear, Aditya? Now, overhead costs. Overhead costs. Now, standard says that overhead costs are also of two types. Overhead costs are also of two types. One is directly attributable. One is directly attributable overhead costs, and another is allocated overhead costs, allocated overheads. Okay, so standard says that if it is directly attributable, meaning thereby if a employee is there who works for the development of the asset and for some other for some other work also, then if we can directly recognize that this much portion of the employee is working, this much percentage of the time the employee is working for the development of the asset, and this much percentage of the time the employee is working for other works, then this is called as directly attributable. This is called as directly attributable. Okay, so it is called directly attributable cost has to be capitalized. This has to be capitalized. But if it is allocated, it will not be capitalized. Okay, now moving on to the advertisement costs. Moving on to the advertisement costs. Now tell me, advertisement costs again. Tell me, can we capitalize the advertisement cost to the cost of the asset? Can we capitalize the advertisement cost to the cost of the asset? No. Then tell me why. Tell me why. Tell me why. Why can't we capitalize? It is not related to the asset. Why? It is if it is related to the asset. If it is related to the asset, then very good, Santosh. Very good, Santosh. That future, see, when we advertise, definitely there will be future economic benefits, but it is not probable that it will be received only. Okay, benefits are not probable. See, let's suppose a company is doing advertisement. Okay, can he force the customers to come and purchase the asset, come and purchase the products from the asset? No, no, no. Right. So though future economic benefits can exist, but it is not probable. Okay, now, so hence we can say that it will not be capitalized. It will not be capitalized. It will not be capitalized. Now, the fourth point is testing cost. Now, the testing cost again are of two types. In the nature of inspection, and in the nature of market survey. Palak, can you suggest one example of advertisement cost related to the asset? It can be anything. No, let's suppose entity has purchased an asset, okay, and whatever the products the machine manufactures, whatever the product that the machine manufactures, now I am advertising about that product. I am advertising about that product, okay, which will give me economic benefits. Now, the testing costs can be of two types, that is inspection costs and market survey cost. Let me explain the meaning of both of these and then discuss the treatment. Inspection costs. Are you aware that the flights on which we travel, they have to undergo inspection after a regular interval? The interval is around 4 or 5 years, around every 4 years. Flights are supposed to go undergo an inspection, and that is mandatory, that is required, without which the flight will not be allowed to operate. Are you aware of it? When I say inspection, I'm talking about major inspection. I'm talking about major inspections, right? Now, if a machinery is brought into the factory, they have to undergo an inspection. It is then only it is made operational in the factory, because if we will not test the machinery before making it operational, it might lead to some accidents, right? So we always do the inspection or a test run of that machinery, before making it operational for the general factory workers, right? We make it we test the asset, right? That is what is inspection cost. Now tell me, without incurring inspection costs, can I operate the machinery? Without incurring inspection cost, can I operate the machinery or the any asset? No, right? So they will be capitalized. Why? Because they directly, this inspection directly doesn't have any economic benefits, but inspection costs act as enabler assets. They act as, right here, they act as enabler assets. They enables the main asset to realize economic benefits, to realize future economic benefits, okay, without which they will not be able to realize the economic benefits. Now, market survey, what happens? A company, let's suppose Reliance opened an amusement park in Mumbai. Reliance opened an amusement park in Mumbai. Okay. Now, after opening the amusement park, Mukesh Ambani asked his son Akash Ambani that tell me, is the amusement park good? Will this be profitable? Do you want to make any changes to this amusement park? Then Akash Ambani says that, see, this is something which I cannot answer. This is something which I cannot answer. Then Mukesh Ambani says, no, my son, I think you should answer. You should understand the business and you should answer me these things. Then Akash Ambani says that, see, this question can be better answered by the person for whom we have made this park. Okay, that is general public. So Mukesh Ambani says, oh, you are smart now. So Mukesh Ambani says now, okay, fine. So let us open the amusement park for the general public now. Let us open the amusement park for the general public for free. Ideally, we will charge, but I am opening it for the first week for free, so that I will collect the feedback from the general public, and if any changes are required to be done, I will make the changes. This is called as market survey. This is called as market survey costs. Now tell me, if I am incurring any cost in the nature of market survey, will I capitalize those costs? No. Because future economic benefits might be there, but it is not probable that it will flow to the entity. It is like a sunk cost. Exactly, Palak, right? So it is like a sunk cost, right? So I'll write here not to be capitalized. Not to be capitalized. Now, another thing. Point number 5. In the process of testing, if some products are manufactured, then definitely I will not throw up those products. Tell me, if in the process of testing some products are manufactured, will I throw up that? No, I will sell it off. Right? So what will I do? I will, whatever is the proceeds from sale of products manufactured in testing phase, then what will be the treatment of this? The standard says that this will be transferred to P&L on actual basis. Is it clear, everyone? Come on, guys, tell me. Yes, here this is you can say a difference between Ind AS from Indian perspective and IFRS. From an Indian perspective, what happens? We adjust from the cost of the asset, okay, but from an Indian perspective, not from IFRS perspective, okay. So that, Yes, but that is from an Indian perspective, so I'm not writing that off here. But from an IFRS perspective, we will transfer it to P&L always. Is that clear, everyone? Is that clear, everyone? Now, so this is all about the directly attributable cost incurred to bring the asset to the location and condition intended by the management. Now, tell me, is this point clear, everyone? Is this point clear, everyone? Now, these 3 points are there. You want a break as of now, or shall I continue? Tell me. Okay, let's break for 10 minutes. Let's break for 10 minutes and then we'll continue further. Okay, done. Now, is it audible? Is it audible now? Okay, wonderful. Now, so before break, we were discussing about the initial measurement, that is the purchase price, non-refundable taxes and the duties, and any other directly attributable costs incurred to bring the asset to the location and condition intended by the management. Right? Now we have to discuss the next point, that is any finance cost under IAS 23. Okay, so definitely I will not be discussing this part now, because I will be discussing this part as part of IAS 23, this borrowing cost chapter. But let me give you a brief understanding about it. Okay, so IAS 23 will say that if you have incurred any finance costs or borrowing cost for construction of an asset, then you can capitalize that borrowing cost to the cost of the asset. This is what it will say. But how to calculate those borrowing costs, everything will be discussed as part of IAS 23. Okay, is that clear, everyone? Is that clear, everyone? I'm not discussing this part. This part I will be discussing as part of IAS 23 only, not here. Okay, now coming to any finance cost under deferred credit terms, let me discuss this part. Deferred credit terms 5-6. Deferred credit terms. What is the meaning of deferred credit terms? Ever purchased any asset on EMI model, EAI model? Tell me. EMI, equal monthly installments, equal annual installments, right? That is called as deferred credit terms. Now let's suppose you wanted to purchase a laptop. You wanted to purchase a laptop. The price of the laptop is $10,000 here. The price of the laptop is $10,000 here. Okay, but you are paying $3,000 here, $3,000 here, at year end 1, at year end 2, at year end 3, $3,000, and at year end 4, again $3,000. Right? So in a sense, you are paying 12,000, but the cash price was 10,000 only. But the cash price was 10,000 only. So tell me, the question is, at what price will you recognize it? At what price will you recognize it? 12,000 or 10,000? Tell me. 12,000 or 10,000? No, because the standard is saying that though you are paying $12,000, because why you are paying 12,000 extra? Why you are paying 2,000 extra? Because you are paying 2,000 extra because of the deferred terms, deferred payment terms. Okay, so this 2,000 extra is in the nature of finance cost, is in the nature of finance cost, and not for the asset, and not for the asset, and hence you will recognize the asset at its cash selling price, at its cash selling price, and not at 12,000, and not at 12,000. Okay, is that clear? And recognize the extra amount that is being charged, that is 2,000 in our case, as finance cost in P&L. Is that clear, everyone? Is that clear, everyone? Now further, Standard further goes on to state that if the cash selling price is not available, if the cash selling price is not available, then what to do? If the cash selling price is not available, then what to do? If it is not available, if it is not available, then what to do? Or it might be the case that it is a no cost EMI, then what to do? Right? If it is a no cost EMI, because we have seen there are models of no cost EMI, right? Tell me yes or no. There are models of no cost EMI also, right? So in that case, what to do? Because in the no cost EMI, what will happen? The cash selling price is 10,000 and here also it is 10,000. The total also comes to 10,000. Then what to do in that case? Then what to do in that case? The standard says that, see, if it is deferred payment terms, then definitely there is a component of finance cost. Okay. Then, but the entity is not charging the finance cost to the customer. Then why shall I record the finance cost? But understand now, if the entity is not charging the finance cost, meaning thereby what? Does it mean the finance cost does not exist? No, it means the finance cost is being borne by the entity itself. Okay, they are bearing the finance cost for that. Okay, meaning thereby they are passing on the discount to the customer. They are giving a discount to the customer. They are giving a discount to the customer, and we have to account for that discount. How exactly? If it is not available, or it is a case of no cost EMI, or it is a case of no cost EMI or EAI model, then in that case I have to calculate the cost of the asset at the present value of contractual payments, using market rate of interest. Is it clear, everyone? Is it clear, everyone? Okay. Now, let us discuss in this case only. Okay. So here, let's suppose this cash selling price is not available to you. Then what will you do? And the market discount rate is 10%. Okay. Discount rate is 10%. Then how will you record it? Discount rate is, let's suppose, 10%. Then how will you record? And what are the general entries? Let me discuss. So first of all, I will calculate cost. I will calculate cost. Now, how to calculate the cost? Year 1, 2, 3, 4 payments that I will do is 3,000, 3,000, 3,000, 3,000. Present value factor at the rate of 10% is 0.9091, 0.8263. Okay, or let me write in three digits only, 0.7510, 0.629. 629 or 683, just check. I think it will be 683. 683, right? Not 629, 683. 0.683. Right now comes the present value. Can you please tell me what is the present value here? Can you please tell me what is the present value? Okay. You can use 3 digits or 4 digits according to your requirements till the time the question is not mentioning anything. If the question mentions anything specifically, then you have to use that. Otherwise, you can use 2 digits, 3 digits. No challenge in that case. Okay. So amount comes to 9510. Right. So now what is journal entry? So journal entry will be like this. Here it will be asset account debit to liability 9510. Okay. Now further, what will I do? I will depreciate the asset on every day, reporting dates. So what will I do? Let's suppose the life is 4 years. So let's suppose the life of the asset is 4 years only. Now, so what will I do? 9510 divided by 4 is how much? 2378. So what will I do? I will record depreciation expense account debit to asset. कितना? 2378. Now ये हो गया year 1, year 2, year 3 and year 4, right? Is this clear everyone? Is this clear everyone? First point. Second point. Now I have to unwind this. Now I have to unwind this also. So what will be the entry on unwinding? So it will be called as finance cost account debit to liability, and I will repay the liability also. So it will be liability account debit to bank. So what will the amount? 951 is the finance cost for the first year, and my liability becomes how much? 9510 plus 951 plus 9510 plus 951 is 10461, out of which I pay off 3000 here. I pay off 3000 here. So my net liability becomes how much? 9510 was my opening liability. I charged the finance cost of 951 and I paid 3000 out of it. So it becomes 7461, right? The discount, the finance cost here will be 746. Okay. And here I will again pay 3000. So what is the journal entry again? Amount, so 7461 plus 746 minus 3000, it comes to 5207. Right now 5207 means 521 is the finance cost at the rate of 10%. Now again I will pay off 3000. So what is the amount again closing? 5207 plus 521 minus 3000 is equals to 2728. Right, 2728. The finance cost is 272. The finance cost is 272, right? Amount which I have to pay is 3000, and the amount which becomes here is nil. So this is how I have to do the accounting. This is how I have to do the accounting. Is it clear, everyone? I have tried to explain the overall. See, what is the amount that you totally paid? What is the amount that you totally paid? Tell me. Total amount paid. Tell me how much. What is the total amount paid? 12,000, right? Out of 12,000, I am saying that 9510 is my cost of the asset, and the remaining, see how much? 951 plus 746 plus 521 plus 272. 951 plus 746 plus 521 plus 272 is comes to 2490. So now if you add 2490 plus 9510, it comes to 12,000. So meaning thereby out of 12,000, 9510 is the cost of the asset and 2490 is the finance cost that will be transferred to P and L. That will be transferred to P and L. Is that clear, everyone? Are you understanding the accounting treatment of it now? Rohit, I'll come to your query, but tell me, is it clear? Is this clear? First tell me this thing. Is this clear, everyone? Okay. Now, assuming this is a no-cost EMI, now understand, if it is a no-cost EMI, don't you think the customer, let's suppose you purchase something on a no-cost EMI, don't you think you have got the benefit? Don't you think you have got the benefit of finance? Right? If you have got the benefit, even if you are not required to pay anything, but what will you do? You will record the finance cost. You will record the transaction at market terms. Not see, if you have entered into a no cost EMI, that is not a market term. Okay, that is not a market term. Okay, that is not a fair value. That is not at fair value. So we have to record each and every transaction at market terms, whether or not it has been incurred into at market terms. Are you understanding this, Rohit? Okay. So now if you have got purchased an asset at no cost EMI, in that case you have to assume that if I would have purchased this asset by paying the whole amount as cash now itself, then also I would have got some other discount. Then also I would have got the similar discount there. Also I would have got it. Are you understanding it? Okay. Now, so this is what is the meaning of deferred credit terms. Because in real world, trust me, there is nothing called as no cost EMI. There is nothing called as no cost EMI. In real world, there is nothing called as no cost EMI. Okay. The prices are increased in a manner so that it is the same everything. Okay, there is nothing called as no cost EMI. Now, so discuss this part also, we discussed this part as well. Now comes the very important part, that is provision for dismantling. If we purchased no cost EMI, but we have to assume purchase as EMI. Yes, yes. Okay, now purchase provision for dismantling or decommissioning or removal costs. Very important point. Point number 7. Provision for decommissioning, dismantling, or restoration or removal costs. Now, understand this part. Accounting treatment is the same, exactly the same. Okay, exactly the same. So understand that if there is if the asset has been sold or has been purchased at deferred credit terms, if the asset has been purchased at deferred credit terms, either you have to record it its cash selling price if that is available. If that is not available, then at present value. That's all. That's all. Okay. Now, provision for decommissioning, dismantling, or restoration or removal costs. Hina, what I'm trying to say here is, if the asset has been purchased at deferred credit terms, that is on EMI or EAI model, then we have to record the asset at its cash selling price if that is available. If it is not available, then at present value of the contractual payments at the market rate of interest. Okay, at market rate of interest. Okay, any difference between the present value or the cash selling price between this and the contractual payments will be called as finance cost, and it will be recognized in P&L as finance expense. Okay, is that clear, Hina, Rohit, Nisha? Wonderful. Now moving on to the next topic. Now understand, guys, that when we talk about provision for decommissioning, dismantling, restoration, or removal cost, there are certain assets. There are certain assets, like for example, generator sets. Have you ever seen a big green color generator sets? Very big green color generator sets, right? Which are mentioned as DG sets. DG sets. Okay. Or let's take the example of oil rigs. Oil rigs. Do you know what exactly is an oil rig? Do you know what exactly is an oil rig? So basically, oil rigs are the equipments which extracts the oil or the petroleum from the sea bed, that extracts oil or petroleum from the sea bed and stores it in a container. Okay, they are very big machineries, very quite very big. If you just have to estimate the level how much big they are, you can say the actual machinery which you can see with an open eye, can be as big as you can say 30 floor building. They are that big. They are that big. Now, now understand, if they has to be installed in between the sea, okay, in the ocean waters, if we have to install it, can we take the entire machinery, installed machinery there and just dig it there? No, we have to take the components of it and then get it installed there, right? Now, similarly, when the machine has to be removed from there, can they be removed like this? No, no, everyone is not sunny there, right? Everyone is not sunny there, right? So they have to first decommission it and then they have to remove it from there, right? So now what happens? First point, this one, the removal of those. Now when we have to remove those assets, that comes with a significant costs. That comes with a significant costs, and the costs are quite very significant to decommission those assets. The costs are quite very significant. Now, when those oil rigs has to be was installed, which were installed in that particular area of the sea for 30 or 40 years, don't you think if from one particular area they will extract the oil for the 30 years, that will destroy or deteriorate the quality of the seabed or the area surrounding that? Tell me, don't you think that will deteriorate the quality, right? So for that, what happens, since that area belongs to the government, okay, so if any entity has to install the oil rig there, they have to take a prior approval from the government. Okay, now let's suppose Reliance Industries wants to install a oil rig in the Indian Ocean, okay, in the Indian territories, in the Indian water territories, okay. So they have to take the approval from the government of India. Now what happens when the Reliance will go and take the permission, will go for taking a permission from the government of India to install oil rigs in the ocean bed, the government of India will say, definitely I will give you the permission, I don't have any challenge. But see, there are few points. Then Mukesh Ambani says, yes, tell me what are the points. Then the government says that, see, if you will use that area for extracting oil or petroleum from that particular area for the next 30 years, then definitely it will deteriorate the quality of that area significantly. Then Mukesh Ambani says that, okay, fine, no challenges. I will when I will remove the oil rig from that place after 30 years, I will restore the place back to normal. I will make arrangements to restore the place back to normal. Now tell me, here when Mukesh Ambani says this, don't you think Mukesh Ambani has taken an obligation on his head? Mukesh Ambani has taken an obligation on his head to restore that place, and he is contractually bound. He is contractually bound that he has to restore that place, right? He becomes contractually bound. Now when Mukesh Ambani becomes contractually bound, and the to restore that place, the cost will be very significant. The cost will be quite very high, right? Now, significant cost plus an obligation. And tell me, without entering into that obligation, can Mukesh Ambani install that oil rig in the seabed? Tell me, without accepting that obligation, can Mukesh Ambani install the oil rig in the seabed? Tell me. No, right? So meaning thereby, see, seabed or this you can say decommissioning cost or restoration cost directly does not give me any economic benefit. Directly they don't give me any economic benefit. But if I don't incur these, then I will not be able to realize the benefits from the asset. So meaning thereby, these restoration costs or decommissioning costs help the main asset, enables the main asset to be operated, and hence again they are enabler assets. Again they are enabler assets, and hence the cost of these assets has to be capitalized to the cost of the asset, to the cost of the oil rig. But now comes the question, since these costs will be incurred at the end of the useful life of the asset, then how will I capitalize it now on the date of purchase? Right? Now everyone will say present value. Okay, and you are correct. You are not wrong, but you are partially correct. You are partially correct. I will discuss how to calculate, but first of all, you have to tell me that this cost will be capitalized to the cost of the asset. Is that logic clear to all of you? Is that logic clear to all of you? First, the logic should be clear, then I will go to the calculation part. Okay, so let me write the logic first. Provision, these costs enables the main asset to be operated. To be operated. Hence, they need to be capitalized to the cost of asset. Here, now, further, at what value? At what value? Now, let me explain this. Let me explain the value. The life of oil rig is, let's suppose, 30 years. The life of oil rig is, let's suppose, 30 years. Now, this is the date of purchase of oil rig. So at the end of 30 years, I have to restore that place. Now tell me, standing as of now, tell me, I am standing here. I am standing here. Okay, I am standing here. Tell me, can I estimate the cost which will be incurred here? Will I be able to estimate the cost which will be incurred at the end of 30 years? Standing as on here, can I estimate the cost which will be incurred at the end of 30 years? Practically not possible. Practically not possible. But now, if I assume that I have to do the restoration today itself, can I estimate the cost for today? Can I estimate the cost for today? Yes, I can do that. I can very well estimate the cost today. So the standard says that don't go for estimating the cost at the end of 30 years, because if you do that, that amount will not be correct, because you don't know that what will be the cost at the end of 30 years. So it will not be correct. It will not be correct. So estimate it here itself. Estimate the amount of restoration costs okay on date of purchase. Okay, estimate today only. Okay, considering today's rates, considering restoration is to be done today. But now tell me, do I need to do the restoration today? Do I need to do the restoration today? No, I have to do the restoration after 30 years, right? So what will I do is, I will check what is the inflation rate in the market. What is the inflation rate in the market? Okay, assuming the same inflation rate for the 30 years, I will send it to the future, considering the inflation rate. Considering the inflation rate, I will send it to the future. right? So now I will have estimated restoration costs. Estimated restoration cost here. Tell me yes or no. Right? Now tell me, whenever we make any plan, don't you think, let's suppose when we are making any plan, we keep a buffer there? Tell me, logically, we always keep a buffer there. Tell me yes or no. We always try to keep a buffer there, right? Now, let's suppose when I'm planning for your SBR classes, I am planning, okay, I will complete the syllabus by this date. Okay, but when I'm saying to my students, I will say that I will complete by this date by taking a margin of 5 or 6 days, because in between there can be some or the other delays, like I'm taking multiple query sessions, or some topic I planned that I will take for 3 hours, but I took that topic for 5 hours, right? It might be the case that there can be some early completions or there can be some delay completions, so I should keep a margin of something, right? So we always try to keep a buffer everywhere. We always try to keep a buffer everywhere. We always try to keep a buffer everywhere. Now, so here also we'll keep a buffer. So what we'll do, we'll write here plus risk premium. Risk premium. Okay, the buffer is named as risk premium. The buffer is named as risk premium. Okay, now this will give you the adjusted restoration costs. Now this restoration costs, you have to bring it to date of purchase, considering the rate of interest, considering the discount rate. Risk adjusted discount rate. Risk adjusted discount rate. Risk adjusted discount rate. And this is the present value which we have to capitalize to the cost of the asset. This present value we have to capitalize to the cost of the asset. This is how we have to measure it off. Tell me, is it clear, everyone? Is it clear, everyone? Are you understanding this concept? Though when you read your book, you will not find all these things written there, but it is required. Okay, it has been tested. It has been tested in the exams also. So it is required. I will discuss that, Siddharth, but first of all, understand this part. Okay. Okay, let me write that also. This present value, then we have to do the unwinding. This present value, we have to do the unwinding every reporting date. Okay. Now, so the journal entry for this will be finance costs account debit to provision for decommissioning restoration costs. And this amount here, the present value, I will pass journal entry asset account debit to provision for decommissioning, restoration, and removal costs. Okay, so this is how the accounting treatment will happen. This is how the accounting treatment will happen. Is it clear, everyone? Tell me, guys, is it clear, everyone? Let me take up an example. But first of all, tell me, is it clear so far theoretically, everyone? And then I'll take up an example and explain it to you guys. Yeah, okay, fine. Let us draft an example. Shall I take I'm taking less useful life so that I can show you the overall calculation. Okay, I'm taking a very less useful life so that I can show you the overall calculation. I'm taking useful life of 3 years only. Okay, but this is not practically, this doesn't happen this way. The practically the useful life is around 30 years or 40 years. Okay, but I'm taking for the sake of easy showing here. Okay, because otherwise I have to show for 30 years and my whole class will go in that itself. Okay, and I don't want to do that. Okay, so for easy calculation I'm taking 3 years. Okay, now discount rate is 10%. Suggest to accounting treatment. So this is the question. Do you want to try? Tell me, do you want to try? Shall I give you 5 minutes to try? Yes, okay. I am giving you 5 minutes from now onwards. Please try, and you have to pass general interest. You have to pass general interest for the 3 years. You have to pass general interest for the entire 3 years. So the time now is 11:51 and you have time till 11:56. In case of subsequent measurement, then how market interest may change, provision amount may change. Okay. I'll take up that query, Rohit, but first of all, solve this question. I'll take up that query as well. Okay, Rohit has already solved it. 601.05 total cost of the asset is 20601. Okay, very good. Very good, Rohit. What about subsequent treatment for the next 3 years? 60.10. Okay, very good. Very good. What about others? Let us solve this part. So I have incurred 2000 here. I'm considering the amount in thousands. Okay. Now 2000 here, and we will incur 800 here. The discount rate is 10%. So the discount amount is 601.05. 601.05. That's what Rohit has mentioned. I believe the amount is correct. Considering a discount rate of 10%, considering a discount rate of 10%. Okay, so what I will do, entry here, I will record asset account debit 2601.05 to bank and to provision for decommissioning and restoration cost. Amount will be 2000, amount will be 601.05, right? Now further what I will do, I will depreciate the asset. Further what I will do, I will depreciate the asset, and journal entry for that will be depreciation account debit to asset. Then I will charge finance cost, so entry will be finance costs account debit to provision for decommissioning and restoration costs. Now I will have to pay decommissioning and restoration costs account debit. I have to pay it off to bank, right? So the entry will be 2601.05 divided by 4 is 3, right? 3 2601.05 divided by 3 is equals to 867, around 867. Right now the finance cost for the first year will be the rate of 10% is 60 something, then 601.05 into 0.1 is 60.05 plus 601.05, so it becomes 66 point, it becomes 66 plus 66 and it becomes 73, right? So now here the closing balance of the provision becomes 660 it becomes 661. 661 plus 66 is 727, and 727 plus 73 is 800, right? Now what will I do? I will pay 800 account debit to bank, provision account debit to bank, 800. So this is how I will do the accounting treatment, meaning thereby the present value will get capitalized to the cost of the asset. Present value will get capitalized to the cost of the asset. Now subsequent unwinding of the provision, will be transferred to finance cost and P&L. Okay, through finance cost to P&L. Okay, is that clear, everyone? Tell me. Is that clear, everyone? Tell me. Now it might be the case. Now it might be the case that here, see, this 800 is an estimate. This 800 is an estimate. So it might be the case that when I'm actually paying it off, I have to pay 850. I have to pay 850. It can be the case. Tell me yes or no. When I'm actually paying at the end of the useful life, I have to pay 850. So the difference again will transfer to P&L that time. Okay, because that is change in the estimate. And the change in the estimates are to be accounted for prospectively in the P&L. I will transfer it off. Is that clear, everyone? Tell me. Okay. Now, I think Rohit or Siddharth, someone asked me that, sir, what if during this year, during these 3 years, the estimates of the provision changes? Then what to do? Though it is not in your syllabus, but still, since this is a query, let me take it up. So if the estimates changes, then we have to calculate the revised carrying amount of the provision, and we have to calculate what is the change in the provision amount due to change of the estimates. See, the provision can change due to 2 reasons: due to unwinding and due to change of the estimates. If the provision is changing due to unwinding, the impact will go to P&L as finance cost. If the provision is changing due to change of the estimates, then the change in the provision due to change of the estimates the impact will be transferred to the asset account. Is that clear, everyone? I will write here, though not a part of syllabus, but still I write here. Okay, provision for DRRC, decommissioning, restoration and removal costs, can change due to two reasons. One is unwinding, and another is you can say change of estimates. Now if it is due to change unwinding, the impact will go to P&L as finance costs. If it is due to change of estimates, the impact will go to asset account. What will be the journal entry? The journal entry will be finance costs account debit to provision for DRRC, and here the entry will be asset account debit to provision for DRRC or vice versa. Is that clear? Can you explain change on account of unwinding? This is what is called a change on account of unwinding, Aditya. This is what is called a change on account of unwinding. The unwinding is called finance costs. When I say unwinding, means opening up the provision, opening up the present value to record the finance cost. This finance cost is nothing but is called as unwinding. This is called as unwinding. This process is called as unwinding. Is that clear, Aditya? Is it clear to everyone till here? Tell me. Is it clear to everyone till here? See, we discussed so far till here, okay? We discussed so far till here. Yeah. So this is the cost that has to be capitalized initially to the cost of the asset. This is the cost to be capitalized to the cost of the asset. Is that clear, everyone till here? Come on, guys, tell me. Okay. So keeping the class till here only today. Okay. So I will request all of you to please revise each and everything whatever we have discussed so far from these notes. Now I will be giving you certain assignments. I will be giving you certain assignments. The assignments will be, you have to revise these notes. Then read and understand your workbook, that is BPP, or study text, that is Kaplan, whichever you are referring to. Okay. Now, and solve one question that I am telling you now. No, that question you will not be able to solve as of now. Okay, fine. The question I will solve in the next class myself only. Okay, no. Next class, okay, we'll try. Definitely we'll try. Okay, but you have to do this one. Right after the class, I will share the notes. Okay, that's all for the day, guys. I hope you enjoyed the session. Okay, that's all for the day. Thank you. Bye-bye.